Alright, hey everyone, Julie Marchese here. Today is November the 3rd, 2012, and in this video I want to give you guys a update on my current positions, what I'm looking for in the markets going forward in the next couple of weeks, and also I do want to do a little trade example or go over a trade that I'm currently in, or the only trade I'm currently in, as I think it's a really good example of the type of trades I'm looking to make um, or at least it's a good example of the type of trading strategy that I employ, and I think it would be a great learning experience for anyone watching this video. So my current positions, anyone following my Twitter would know that I'm currently short the equity market, about 75% of my max risk. Basically, what I do is I take a look at my account equity, and I take a look at my the current percentage amount that would be my max risk. So at this point, I like to say that 3% of my account is my max risk. And basically, I take a look at the type of trades that are available to me right now, and I'll employ a certain percentage of that max risk. So if I wanted to get short equities, for example, short of the S&P 500, what I basically do is I take a look at what the price is. If I were to short the market right here, where would my stop be? And then I'd take a look at where my stop is, and then I would take a look at how much that stop would be on whatever size, and then I would change my size to the amount of risk that I want to have compared to my max total risk I can have at any point in time. So I got short about 50% of my max risk on November the 1st. I'm currently short 75% as I did add on Friday yesterday, add another 25%. But let's go over this short trade that I entered, as once again I think it's it's one of the best trades I think that have come up in the S&P in quite a while, since we've basically been in a chop for the last 3 months. So basically, I was looking at this 3-day downtrend here. I was trying to play it to the long side on this first down bar. But I took some profits on the top here, then I obviously got stopped out on the rest, and that basically turned out to be a flat trade. It really wasn't a good reward risk trade. In hindsight, I probably shouldn't have taken it, but I turned out okay from it. But I basically looked at this, sharp down move. We saw a 50-point drop in basically 4 trading days. That's huge. That's pretty big compared to what we've seen in the past few months. It's a big expansion of volatility. And we didn't see any snapback higher. When I'm looking at a market in a general uptrend, which at that point I would say that the market was still in an uptrend, whenever we see major sharp down moves, what I like to see is quick reversals higher. That tells me that the market is still, the market participants are still willing to buy. For example, back in June, saw this sharp reversal here, late June. Look at that. Huge one-day bar, dwarfing basically all the movement in the past. Sharp reversal here, huge 2-day move all the way up to new highs. 50-point move in 2 days to the upside. Sharp reversal here, huge 1-day move to new highs. All the powerful bars are to the upside. But now, in mid-October, we saw a huge powerful bar to the downside after a few months of ranging, telling me that the bears were starting to come into control. And once we broke the trend line, we didn't snap back higher like we usually did. What happened was we ranged, which tells me that the market is comfortable with value below the last value area we had here in 1450. In other words, market participants think that the S&P is more fairly priced at 1405 or so, as opposed to 1450. Okay, so that's a huge psychological shift. We broke the 50-day EMA, which is a important thing to look at. And really for the first time, discounting these few days here, we saw a close. Yeah, actually, I don't see a close below the lower Bollinger Band. This was the first time we closed below the lower Bollinger Band since basically the start of this rally, June 1st. What that tells me is we have actually, for the first time, seen powerful selling. If we were able to close below the lower Bollinger Band, actually twice we did. So basically, we had a large down move on volume broken a large uptrend, closed below lower Bollinger Band, broke below the 50-day EMA, accepted value lower. This tells me we're in a downtrend in equity markets, and the other risk markets are confirming this. Take a look at oil. You know, we broke out of an 88 to $94 range. That's $6 range here. Closed below the lower Bollinger Band. Got it really extended from the 50-day EMA and did not snap back. We just basically puttered around here. Couldn't even test this resistance level up here. We couldn't even test this major low we made at 88, and we just reversed right lower. Take a look at gold. Gold just came out of this major range here to the downside. Very consistent down days more powerful than up days. And then we obviously today, Friday, broke down very powerfully on huge volume. You know, risk does not look good here, and right now I would consider gold as a risk market. So, you know, all these things were telling me, okay, other risk markets are not confirming this bounce in equities over here that we had on Thursday. We're in a confirmed downtrend, medium-term downtrend in my opinion. You know, we had this major pivot point at 1435, which was basically the third down day break, this other large down day we had here. You know, if we break above that, that would be really the only lower high that we made in this new downtrend that I perceive that we're forming. So if this broke, you know, we would have a chance that we would reclaim the uptrend. So basically what I said is, okay, Thursday, we have unemployment Friday tomorrow. We have a risk of large movements either way. Don't want to have too much risk on. Let's do 50% risk. So I shorted 50% risk under the assumption that we're in a downtrend. If we're in a downtrend, we should expect movement lower below this low we made here at 1390. And next target being 1365. And also a short at 1322 half at the time when I shorted. Max risk would be up to, say, above this pivot point here. Let's take a look at the 60-minute chart. So basically at 1437 was my risk. So I was risking about 15 points here to potentially make around 60 points. So I had a 4-to-1 risk. So good trade starting out. Then we had unemployment Friday. I was only risking, once again, 50% my risk. I knew what my stop was, and I knew what my target was. Unemployment Friday happens. We have a good report. You know, 171,000 jobs were created. Much better than the expected number of, I think it was around 120,000. So that's a really good number. And the market, let's take a look at the intraday chart, only rallies about 5 points. You know, that's not a very big move. What that told me was that yesterday, market participants priced in a better report. Although it wasn't being priced in other risk markets, in the equity markets, a good report was priced in. And the fact that we could not see a rally right on the open, which is this bar here, the third 5-minute down bar we saw broken this important pivot point on the unemployment move, I shorted another 25% of my risk. Why did I do that? Well, as a macro trader, although I place obviously huge emphasis on technical analysis, definitely the majority, I like to only take trades when I have a macro picture confirming it as well. Really the macro trade right here is that obviously the global economy is still basically slowing down. We're not seeing really growth anywhere around the world, or growth that, you know, would warrant higher risk asset prices. But what we do have is easy central bank money. You know, we have you know, money coming into the markets due to the central banks basically putting a stop in the market. The fact that we had the reaction higher from QE3 and that we couldn't really, you know, do anything other than the reaction move up to 1475, the fact that we basically stuttered around here and could not move higher was telling me that the market participants are not believing in QE3 right now. Right now, there are doubts. Now, obviously, and I would be willing to put money in this later on, I think that the Fed will step in again, and then we will see another rally. But for now, market participants are not believing it. And that's really the trade right now. So once again, going back to the reason why I shorted 25% is as a macro trader, when I'm in an uptrend, I expect bad reports, bad economic reports to be ignored. And in a downtrend, I expect good economic reports to be ignored, bad reports to be emphasized. And Friday was a textbook example of a good economic report being ignored. And we saw, that small rally. And the moment I started to see the market just start coming back in, probably to reverse the entire reaction at 8:30, I shorted another 25% confidently. I got my average price higher to about 14.25. So stop was only about, 10, 12 points at that point. Target was still a good 60 points. So I was able to turn it back up to about a 5-to-1, 6-to-1 reward to risk. And the market proceeded to fall through, break the reaction low, and as you can see later on in the day, we really sold off. So the market held its downtrend pivot point. You can see right over here, 1435, couldn't even come up to test it, held that important pivot point and just sold right off through. And the other risk markets were really telling us the same type of thing. Oil could not rally with the equity markets or as powerfully as the equity markets did on Thursday. Gold actually was lower on that day. The euro was lower on that day. The dollar was higher. All these things were telling me that only equity markets were pricing in a good report and that other risk markets were not confirming. And when other risk markets are not confirming, and most of them are actually, looking weak, I'm usually looking to take the equity market with the other risk markets. And that was the same trade we had basically in May, April, when oil was underperforming and then the market fell right through. So the target on this trade, and going back to why I think this is a good learning experience, a good, a trade to learn from, was that I entered the trade 14.25 as a whole, risking only up to 14.37, and target is down to 60. So that's a 5-to-1 reward to risk. And if you continue to take high reward to risk trades over the long run, even with a low batting average, you will still make money. Even if you win only 30% of the times, if your average win to loss ratio is 5-to-1, you still will make money in the end. So it takes a lot of stress off of a trader trying to make every single time, So, looking for these high reward to risk opportunities like I found in the equity market here, whatever you really base it upon, fundamental analysis, technical analysis, sentimental analysis, in the end, it's a good trading strategy and risk management strategy. Because if you're one of those traders who likes to take small profits, but have a win rate of 85% of the time, the times that you lose and you lose like large multiples of what you make per trade, that can have psychological effects on you, and you have to be very, very confident in your strategy in order to be successful in the long run. And frankly, not many people are prepared to trade in that fashion. So the best way to do is just high reward to risk opportunities, and like the one that I spotted on Thursday. And I'm looking for the equity market to break down 1365. It's 50% retracement of this entire move higher here, and the 1.382 extension of this move here. That should be a good target for equity markets. But in conclusion, basically, I think equity markets are going lower. Oil does look very weak, couldn't make a rally. Gold looks weak as well. Obviously, this huge breakdown was telling me that somebody's selling. This huge breakdown part is telling me also that this entire move we've seen in August and September is potentially going to be completely reversed. Just lots of weakness in these risk markets, copper as well. I would be looking out to see a break of the euro of 128, potentially down to the 0.618 extension at 126. And then last but not least, the bond market really isn't doing anything. just really choppy, smack dab in the middle of this range. But if the equity markets can start selling off, if the other risk markets can start selling off, we could see bonds at these highs at 153 handle around that area. So that's what I'm looking for in the markets, guys. Thanks for watching this video. Hope you learned a lot from the trade example. Thanks.